Someone tells you the stock market returns about 10% a year, so you picture your money climbing a neat little staircase, 10%, then 10, then 10. Now look at what actually happened. Up 29, down 18, up 16, down 4. The staircase is a lie. And believing in it is what makes people quit at the worst possible moment. So before the next scary headline talks you out of your own plan, give me about 10 calm minutes. By the end, you'll know what the market really pays, why the honest number is lower than the one you've been sold, and why that smooth staircase in your head is the dangerous part. Here's why this matters more than it sounds. Almost everyone who invests carries a number in their head, and for most people that number is 10% a year. It feels safe, like a promise. Then a normal, ordinary bad year shows up. The account drops 18%, and the promise feels broken. That's the dangerous moment. Not the drop itself, but the gap between what you expected and what you got. People who expected a smooth ride sell in a panic and lock in the loss. People who expected a bumpy ride just keep going. Same market, same year, completely different outcome, and the only thing that changed was the expectation they started with. So let's fix the expectation. Before we go further, one honest ask. If a calm, clear-eyed take on money is what you've been missing, subscribe and this lands in your feed every week. Then let's get back to that famous 10%. So where does that 10% even come from? It's not made up. Look back over about a century of the broad American stock market, all the booms and all the busts stitched together, and the long-run average really does land near 10% a year. That number is real, and it's a fair anchor. But here's the trap. That single, tidy number hides three things nobody tells you. First, it's before inflation, so it's not what you can actually spend. Second, that average almost never shows up in any single year. And third, it doesn't arrive smoothly, it comes in lumpy decades. Get those three straight and a scary market loses its power to scare you out. Let's take them one at a time. Correction 1. That 10% is a nominal number, which is just a fancy way of saying it's before inflation takes its cut. And inflation always takes a cut. Warren Buffett has called inflation a kind of tax, an invisible one, because it quietly shrinks what every dollar can buy while the dollar amount still looks fine. Picture it simply. If your account grows 10% in a year, but the cost of everything you buy quietly climbs a few percent, only the slice left over actually made you richer. So once you subtract the long-run bite of rising prices, that headline 10% has historically landed closer to about 7% after inflation. 7% is the honest number, because that's the one that actually buys more groceries, more years of freedom, a bigger life down the road. It's still a wonderful return. It's just not the number on the poster. Correction 2, and this is the big one. That average almost never actually happens. Think about what an average is. If I have one foot in a bucket of ice and the other in a bucket of fire, on average I'm comfortable, and that's obviously nonsense. The market works the same way. In any given year, stocks are usually either up big or down hard. A calm, boring year that lands right around 10% is one of the rarest years there is. Most years are a party or a panic, and the tidy average is just where all of it settles over time. So here's the line to remember. The market's average year almost never happens. It's up 29 or down 18. About 10% is just where all that chaos lands if you're patient enough to stay. Correction 3. Those returns don't just bounce around year to year. They clump together into whole decades that feel nothing alike. There are roaring decades where it feels like you can't lose. And there are lost decades where a long stretch of years goes almost nowhere. The 1990s were a party. Then the 10 years from 2000 to 2009, with two separate crashes, left the market roughly flat, a whole decade of standing still. If you started investing at the wrong end of one of those flat stretches, 10% a year would have felt like a cruel joke. And yet the decade that clawed out of those ashes turned into one of the strongest runs the market has ever handed, the people who simply stayed put. But zoom out across several decades, and the roaring stretches and the dead stretches blend toward that long-run average. The catch is, you have to be there for all of it. The good years pay you back for the bad ones, but only if you're still in the seat when they finally arrive. So why does all this matter for your actual money? Because the wrong expectation is what turns a normal drop into a permanent loss. Picture two people who bought the exact same fund on the exact same day. The market falls 18%. The first one expected a smooth 10%, so this feels like the plan is broken, like something is deeply wrong, and they sell to make the fear stop. The second one expected wild years that average out, so a down year is just the price of admission, and they don't touch a thing. A year or two later, the market recovers, as it always eventually has. The second person is whole again, and then some. The first person turned a temporary dip into a real, cashed-in loss, and usually they're too spooked to get back in before the rebound. The psychologist, Daniel Kahneman, showed that a loss stings about twice as hard as the same-sized gain feels good. And that lopsided pain is exactly what the wrong expectation amplifies. So the fix is almost embarrassingly simple. Expect the bumps and stay in your seat. So what should you actually plan around? Not 10%, and not a straight line. Plan around a bumpy ride that has historically rewarded patience, with something like 7% a year after inflation, spread over long stretches of time. John Bogle built his whole life around one quiet idea. Don't waste your energy trying to beat the market's average. Just calmly capture it and let time do the heavy lifting. That's the move. Own the whole market cheaply, and then let the years stack up. Two honest warnings though, because I'm not selling you a fantasy. Nobody can promise the future will match the past. That 7% is history, not a guarantee. And if you buy in when the market is already historically expensive, your returns over the next decade can come in noticeably lower. So hold the number loosely. The point isn't the exact figure. The point is the shape. Up a lot, down a lot, grinding higher over decades if you let it. Let's bring it home. 1. That famous 10% is real, but it's before inflation, so the number that actually buys your groceries is closer to 7%. 2. The average is a destination, not a ride. Almost no single year lands anywhere near it. And 3. Returns show up in lumpy decades, so the whole game is staying invested long enough for the good stretches to arrive. Get those 3 right and the next red headline loses its power over you. So here's your one move for the next 24 hours, and it costs you nothing. Pull up a long-term chart of a broad market index, and don't look at the smooth line. Look at the individual years. Count how many of them actually landed within a couple points of 10%. I'll save you the suspense, it's almost none. And seeing that with your own eyes is what inoculates you against the next terrifying headline. Because remember what the average really is. The market's average year almost never happens. It's up 29 or down 18. About 10% is just where all that chaos lands if you're patient enough to stay. The bumps aren't a sign the plan is broken, the bumps are the price you pay for the returns. Expect them, and you get to keep your money working while everyone else is panicking. So if you'd rather invest with honest expectations than hopeful ones, subscribe. Calm investors. Build wealth with patience, not panic.